Hello, everyone. My name is Sergio Garcia, and today I'm just here to hopefully provide you guys with some very important information on why credit is important and why you should take it seriously. So let's just jump right in. So, here we're going to go over the history of credit. So, it all started with Henry Ford's Model T. That's a car, if you guys didn't know. It was released in 1908, and this really kind of sparked um, credit a little bit. So it started the auto financing. So the Model T was very expensive for that time, and people really couldn't afford it. So people started financing them. Ford actually just let people make about 30% of the price of the car as a down payment, and then the rest they were able to pay off in a certain amount of time. And then they moved on. By the 1930s, you could basically finance anything from appliances to furniture to anything you can think of. You could basically finance it. And then in 1958, Bank Americard released their credit card, and this one actually really changed a lot because at the time most credit cards were actually only used with one merchant. So if you get so think of it like a store credit card now. If you go to Macy's and get their credit card, you can only use it at Macy's. But in 1958, Bank Americard released theirs, and you can use it. You could use it at multiple merchants. Um, and actually, Bank Americard is actually now Visa. So, and then in 1970, the Fair Credit Reporting Act was passed, and that basically just regulated a lot of what was being reported and what was being basically collected by these agencies. And then in 1980, three credit reporting agencies established universal coverage, and those are Equifax, Experian, and TransUnion. And then not too much happened after that except for your FICO score. And then now let's jump into types of credit. So there are a wide variety of types of credit. The most common one is credit cards. But then you can go from credit cards to auto loans, personal loans. There are unsecured loans or secured loans, but we won't jump into that too much today. And then mortgages, which is basically when you finance your home purchase. RV loans, which is any recreational vehicle, not just specific to RVs themselves. So you can do boats, ATVs, anything like that. And then lines of credit, which is basically like a credit card, but you don't always get an actual card for it. And then there's HELOCs, where you basically use the equity in your home to take a loan out on that. Basically use that as a line of credit. And then a HE loan is basically the same thing, but you actually have amortized payments over a certain amount of time. Okay, so now let's move on. There are five main factors that affect your credit score. The largest and most important is your payment history. So if you have a lot of missed payments, this is going to affect your score largely. And then let's move on to amount of debt. That is the second one that affects mostly. So if you have a high amount of debt, then that will affect your score. Obviously, if you have less debt, not too much debt, or have zero debt, then that will um, positively impact your score. And then the next three are all about the same weight on your credit score. The length of credit is next with 15%. And that basically just means they want people who have had credit for a longer period of time. They're more credit worthy, I guess you could say. And then the next two are new credit and diversity. So creditors want to see that you have different types, or you have had different types of credit. So auto loan, credit cards, mortgages, things like that. And then new credit, however many times you have applied for new credit in the past like 2 years, I believe is what it is. And then these are just some other factors that could affect your score. So credit inquiries, like I said, that was a part of the last slide there a little bit. You don't want to apply for too much new credit because that could set off red flags. Also, bankruptcies, if you have any bankruptcies in the past, those usually stay on your credit report for about 10 years, I believe. Um, Charged off accounts, so if you have credit cards or even bank accounts anywhere and you go into the negative and you don't pay them off, they get charged off. Your debt to income ratio is basically how much debt to income you have. So if the higher amount of debt, the lower or the worse it is for your ratio. Um, Foreclosures and then credit usage. So you normally want to stay under 30% of using your credit. So if you have $1,000, you usually want to stay $1,000 credit line. You usually want to stay under $300 that you've used on that. Obviously, you can use more, but you want to pay those off. So what is a credit report? Credit report has a lot of information on it, got a lot of good information. You actually want to check these quite often, not too often, but you get three free of these a year, and they do not affect your credit score. So a little bit of what is on it. So the first top section is going to have all your identifying information. So your name, your address, your social security number, your birth date, things like that. And then right below that, you're going to see the types of credits. So that's where you'll see your credit card balances, your mortgage balance, your student loans, and it'll have the date they were opened and the balances on them. Right below that, you'll have the credit inquiries. So who have you applied recently with credit for? So if you've applied for a new credit card, it'll all show up there. And then right under that, you'll have any collections or things that have been sent to collections, like bankruptcies, foreclosures, things like that. And then who uses your credit report or your credit score? And this, as you can see, is a pretty long list, and this is just only a few that I named. So any lenders, so most of those are usually banks or financial institutions, employers, landlords, utility companies, cell phone companies, insurance companies, debt collectors, government agencies such as people who do child support, or if you're applying for any public assistance like food stamps or anything like that, and then the insurance companies. All of these are very likely to use your score. Just a few examples. Your employers, especially if you're in a finance industry, they want to see that you are actually practicing what you preach. And then cell phone companies, a lot of them use it to see how large of a security deposit they are going to ask from you. And that's just a few examples on what they actually use it for. So now a little bit of a summary. As you could see from the last slide, many of the businesses and companies and industries and organizations and things like that use your credit score. And actually, your credit score shouldn't be intimidating. It should be something that can be used for your benefit, but it can also obviously work against you. Your credit is something that is very, very largely under your control. I would say about 90% is under your control. And then once you understand your credit, it's so much easier to control. So if you understand how to positively impact your credit, then you'll obviously know what to do and what to try to avoid. And obviously sometimes you'll have mishaps. Maybe sometimes you forget to make a payment or anything like that. You can always bounce back from it. So try not to freak out about it too much. And I know a lot of people try not to think about it or don't really want to talk about it, but it's something that, as you can see, a lot of people use your credit score. So it shouldn't be something that you're shying away from or trying not to learn from, because it will impact you greatly. So yeah, there you have it.